Why is US dollar to Japanese yen rising despite BOJ hawkish signals? How far can the dollar-yen rally go before intervention becomes real? This US dollar to Japanese yen technical analysis today covers the 160.25 breakout prediction, yen support and resistance levels from 159.50 down to 158.75, and the macro forces driving Forex markets right now. US dollar to Japanese yen is sitting at 159.99. Again. But this time, the majority of retail traders are short. I'm going to say that again because it's the most dangerous fact on the board today. The herd is short. And the Bank of Japan just publicly vowed to debate the pros and cons of a rate hike in June. You would think that would make the yen stronger, right? It hasn't. Price is grinding higher, not lower. That is a trap, pure and simple. There is one danger zone and one hidden opportunity right now, and I'll show you both. Stay to the end because I'm giving you 3 exact levels you can trade tomorrow, complete with entries, stops, and invalidation rules that separate winners from account destroyers. MY session buys for US dollar to Japanese yen right now is trending, but it's a toxic trend, and you need to treat it with caution. The monthly trend is strong buy. The weekly is strong buy. The daily, the 4-hour, the 1-hour, every single time frame I have in front of me prints strong buy. The moving averages are in perfect bullish alignment from the 200-week all the way down. Price is above the 5-day moving average at 159.81, above the 10. At 159.54, above the 20 at 159.23, and miles above the 200 at 155.93. The path of least resistance is up. But the moment we step above 160.25, everything accelerates. That is the invalidation level for any bearish argument. Write this number down. 158.75. If we get a 4-hour candle close below 158.75, the entire bullish structure resets. Until that happens, dips are being bought. Here's the micro insight about where the herd is positioned. Analyst sentiment shows a majority sell bias climbing. Retail is stacking shorts against 160, expecting intervention. That means stop losses are clustering above 160.25 and 160.56. When stops cluster above a key resistance and the trend is up, you get a liquidity magnet. The big players know exactly where those stops sit. Do not be the fuel. Let's walk through the charts exactly as I see them on my screens right now, from the weekly down to the 60-minute, so you understand why this level at 160.25 is the entire ballgame. On the weekly, US dollar to Japanese yen has been in an uninterrupted bull run. The moving average structure is textbook trend continuation. Price is above the 200-week moving average, the 100, the 50. The slope of every single one of them is pointing north. There is no bearish divergence on the weekly MACD. Momentum is positive and steady. The stochastic is in the 70s, which in a strong trend is not overbought. It's a sign of power. Now drop to the daily. The 20-day moving average at 159.23 has acted as a springboard for the last 3 sessions. Every touch of that level has brought in buyers. The 10-day at 159.54 is holding above the 20-day, confirming the short-term momentum is still accelerating. The RSI at 62.2, nowhere near extreme. The MACD histogram is printing 0.270, firmly above the zero line, and there is no bearish cross. I'm looking for any hidden divergence on the 4-hour chart that would warn me of exhaustion. Here's what most traders miss. Most see a price approaching a big round number like 160 and they instinctively want to fade it, hunting for massive reversal. But the 4-hour MACD right now is not giving you a negative divergence. Price has been compressing sideways in a tight range between 159 and 160.25, while momentum has reset from overbought levels without a price collapse. That's a bull flag, not a top. The stochastic on the 9-6 setting is at 70.58, elevated but not screaming reversal. The bull-bear indicator at 0.996 is practically pinned at the top of its range, which tells you buying pressure is dominant. Now let's talk support and resistance with exact numbers because these are the only levels that matter. For your execution tomorrow, support structure begins at 159.50. That's the intraday demand zone that held every single dip during the last Asian session. Below that, 159.06 is a deeper value area, previously a resistance that has now flipped to support. Then the line in the sand, 158.75. That is the last bastion of the short-term bullish structure. On the resistance side, it's a stack zone. 160.25 is the immediate barrier. Every test so far has been rejected by just a handful of pips. Above that, 160.56 is the next sell zone, the high from the previous intervention scare. And if that breaks, 161 flat becomes the magnet. Now here's the cross-asset linkage you cannot ignore. US dollar to Japanese yen is moving tick for tick with the US 10-year yield. The yield differential between US and Japanese government bonds is hovering at extreme wides. As long as that spread stays elevated, the yen has a fundamental headwind that no amount of BOJ verbal intervention can neutralize. The Japanese rate hike being debated is maybe 10 or 15 basis points. The gap is 350 basis points. Do the math. This is why every dip in US dollar to Japanese yen over the past month has been bought violently. The carry trade is alive and well. The next signal changes everything. If the US 10-year yield pushes above 4.6%, US dollar to Japanese yen will rip through 160.25 like it's not even there. Yesterday's headline flipped the narrative, but not the way the crowd thought it would. BOJ Governor Ueda explicitly stated the board will debate the pros and cons of a rate hike, signaling that June is live. A hawkish BOJ. And yet, US dollar to Japanese yen closed higher on the day. That tells you everything you need to know about what's priced in. The market is pricing a single token hike that does not close the carry trade gap. What matters more is what Ueda did not say. He did not signal a reduction in bond purchases. He did not commit to a hiking cycle. The real rate differential remains overwhelmingly in favor of the dollar. Now here's the intervention ghost, the thing that haunts this pair above 160. Japan's Ministry of Finance has drawn a line in the sand verbally, but they haven't pulled the trigger. Analysts note that a majority sell bias has climbed aggressively. Retail traders are short, betting on intervention. That positioning is the powder keg. If the BOJ hikes and still fails to move the needle, the shorts get squeezed. If the BOJ does nothing in June, the shorts get annihilated. Either scenario above 160.25 spells trouble for anyone fighting the trend. The 1 to 2 week directional lean is cautiously bullish toward 161 and possibly 162, provided US data does not crumble. The invalidation event for this lean is a confirmed BOJ intervention, not just talk, or a daily close below 158.75. Right now, I want to know what you think. Do you see the dollar breaking 161 this week? Comment yes or no right now in the comment section. I'm tracking the consensus, and the split on this is going to be wild. Most people skip this section. That's exactly where the money is made. Keep watching, because the 3 plans I'm about to give you cover every possible outcome with sniper-level precision. I'm going to label each one and give you the exact trigger, the exact stop, the exact targets, and the one condition that voids the entire setup. After the second strategy, I'm going to ask you something specific, so don't click away. Strategy 1, the sniper, conservative. This is the plan for patient traders who want to buy into the trend at a discount. The setup triggers if US dollar to Japanese yen pulls back to the 159.50 support zone and prints a 1-hour bullish engulfing candle close above 159.60. That tells you the buyers have absorbed the selling pressure at the demand level. Your stop loss goes at 159 flat. That's 10 pips below the 159.06 support, giving the trade room to breathe while keeping your risk mechanical. Target 1 is the retest of 160.25, offering a clean 1-to-1.5 reward to risk. Target 2 is 160.55, just below the 160.56 resistance, netting you roughly a 1 to 2.8 reward to risk. This entire setup is void if we get a 4-hour candle close below 158.75. At that point, The structure has shifted and you do not want to be long the sniper, conservative, entry. 159.50, 1H bullish engulfing close above 159.60, stop loss. 159.00 take profit 1. 160.25 take profit 2. 160.55 risk, reward. (1 2.8 are invalidation. Void if 4H close below 158.75 strategy 2. The active trader, standard. This is the breakout play for traders who want to ride the momentum if the wall at 160.25 shatters. Your trigger is a 1-hour candle close above 160.30, giving you a 5-pip confirmation buffer above the resistance. You enter on that close. The stop loss sits at 159.85, back inside the prior consolidation zone and below the 5-period moving average on the 1-hour chart. That keeps your risk tight to roughly 45 pips. Target 1 is 160.55, just beneath the next resistance cluster. Once target 1 is hit, move your stop to break even and let the rest run. Target 2 is 161 flat. The risk reward on this setup sits around 1 to 1.7 before the trailing stop activates, and potentially 1 to 3 if the full target is captured. This is the strategy that capitalizes on the short squeeze dynamic I described earlier to the active trader, standard, entry. 160.30, 1H close above, stop loss. 159.85 take profit 1. 160.55 take profit 2. 161.00 risk, reward. (1 1.7 R, 1 3 R if TP2 hit, trailing stop. Move to break even after TP1 invalidation. False breakout if 1H candle closes back below 160.10 now. Before I reveal the aggressor play, I want you to type your US dollar to Japanese yen range for tomorrow in the comments. Give me a high and a low. Let's see who's aligned with the liquidity map. Drop it now. Strategy 3, the aggressor. High risk. This is the counter-trend fade for traders who can lose small and manage risk with zero emotion. The setup only activates if price spikes into the 160.50 to 160.56 resistance zone and prints a clear rejection wick on the 15-minute chart, specifically a shooting star or a long upper wick of at least 20 pips. You enter short at 160.45. Anticipating the rejection will accelerate as short-term profit-taking and intervention fears kick in. Your stop loss goes at 160.75, just above the spike high. That's a 30-pip stop. Target 1 is 160 flat, pulling you out quickly if the rejection is genuine. Target 2 is 159.55, capturing the retreat back into the intraday support. This is a 1 to 3 risk reward if both targets trigger, but I warn you, this is against the overarching trend. The only reason the setup has any edge is the positioning extreme and the intervention ghost. If the 15-minute candle closes above 160.56 with conviction, do not take this trade. You are standing in front of a freight train. The aggressor, high risk, entry, 160.45, 15-minute rejection wick at 160.50 to 160.56 zone, stop loss. 160.75 take profit 1. 160.00 take profit 2. 159.55 risk, reward. (1 3 are invalidation. 15-minute close above 160.56 voids the fade. Never risk more than 1 to 2% of your account on any single trade. Avoid holding through high-impact news events like US yield spikes or unscheduled BOJ statements. Stops are non-negotiable. Mental stops are account killers. Trading is a game of survival. The only way you get to trade the next explosive move is by protecting your capital today. The single most critical level to carry into tomorrow's session is 160.25. That is the tripwire. A daily close above it unlocks 161 and a cascade of stop buying. A daily rejection and a break back below 158.75 opens a deeper correction toward 157.68. Tomorrow, I'm zeroing in on the hidden divergence in gold and the gamma flip building in the S&P 500. That video is live on the channel right now. Tap the end screen to continue your preparation. If this video gave you a clear, actionable plan for US dollar to Japanese yen, smash the like button. It tells the algorithm to serve this analysis to more traders before the move happens. Subscribe, hit the bell, and lock in your seat for tomorrow's institutional breakdown. I'll see you in the next one.